Hi, everyone. I'm Dale Pinkert. I'm the face of face. Oh, looks like I can't turn my camera on. Weird. Okay. Anyway, stop video. I want to do a little coaching this morning. Hello, everyone. How you doing, Brock, Kevin, Ren, Ingmar, Nikita, Kevin, Samir, everyone? You could call me Dale or Coach Samar. All right. So, we cover a lot of things here. DJ, Didier, Bill. We cover, and in the morning, I go over different instruments that I see. But I just want to tell you about my experience on the floor of the CME. I knew traders that were in the cattle pit that never left the cattle pit. That's all they traded. They knew that market like the back of their hand, and they did pretty well. They didn't diversify into hogs and currencies and everything else. So, I know Steve talks about screening and following a lot of things so that, at times, yeah, at times you could find things, sometimes what you mainly trade, there's nothing to do. And that's the main reason, in my view, to screen everything else so that you could remain active. But, I recommend, especially for people that are fairly new to trading, to narrow their focus to a couple of instruments and get to know them well, get to know every, support level, every formation. You don't have to be a portfolio trader to make money. I mean, let's even talk about investing.com viewers are here today. So if you were long Facebook after the COVID crash or almost anything, did you have to be in a portfolio? So then this brings me to another point. Recognizing relative strength and weakness within a complex. So here we have the dollar right here, on the verge of giving it up. I think it's a buy right here. Okay, with stops under the low of the day. Okay, I mean, if it doesn't hold here, we're going to take out 2.5 and we're going to, I don't know, 91.40. That's one of Andre's targets off a real nice harmonic workup that he did. But, the euro is weaker than the pound. So, there's a chance we could fade from here and you're wrong over the high. But you look at this euro, you look at cable, and then you look at Aussie. What's the weak sister? Which one's demonstrating, if you want to be long the dollar, which one's demonstrating the most weakness? Is it the European currencies? Or is it the commodity currencies? Okay, Jess, I like it. I'm looking for 70.50 for the first target there. Okay, anyway, I'm just not talking about the fundamentals. I'm just talking about the chart and the action here. I mean, this is taken out early week highs. Aussie hasn't. Okay. So just a demonstration, you want to be short on rallies, the relative weakness, and you want to be long on dips, the relative strength. So I just wanted to make a few points that you don't have to trade 10 different instruments and you don't even have to know. That's why when I go through things and say, I don't know, it's okay. Because it really only takes one. Yeah, it is. And that is weaker. The only thing, yeah, right, Nikita. I was looking at that. The Aussie Kiwi is tempting for a top pick the last couple days. So here you go. We're not here's your 2-hour. We're not making new highs. There's a daily, pretty good reading on the daily, hard to fade. We are confirming this new high in the daily. That's important. That's why I'm being patient too. But you look at some other time frames, 4 hours not confirming, 2 hours not confirming, 1 hour is not confirming, 15-minute isn't, even the 15-minute is not converting here. Okay, so this I'm short the Aussie because I'm actually looking for a turn here. Okay, so right now it doesn't look like it's going to happen. But although Kiwi is the weakest, I'm short Aussie. Okay, because I think that this Aussie Kiwi, this pairing is pretty stretched. So that's really what I wanted to talk about to everyone. Let's see what else is going on. You know, you have another reason for Aussie and Kiwi is the other commodity currency, CAD, is making new lows right here. Okay, CAD is making new lows. Aussie isn't making new highs. So here's my first target for it down here. And getting to stock indexes, I think we're about 30 handles away from, I think the high was 33.98, and we're starting to diverge on multiple time frames in S&Ps. There's your daily, 4 hours still, you know, we made a new high. Look at this glaring divergence. We could probably even make another high here. 2 hour diverging at this new high. So I think between now and the Monday, Tuesday, we're going to have a high. Yeah, Nasdaq has been the weak sister, but I was looking at this on Nasdaq. It's the 2 hour confirmed, and more than that is the 4. See this right here? So what would be a short to me, Forex gal, would be Nasdaq making new highs over the next 3 days, and the 4 hour reading stay under 70. So I'm thinking the next 3 days I'll be taking a shot there. That would also favor the short side of Aussie. Commodity currencies seem to suffer worse during some kind of risk off. So that's my review. Any other market you guys want me to take a look at before I hand it over to Blake? Give me a Y if you, well, I just did it. Okay, I'll just do the euro because the whole team's here. This could be a failing rally in euro here. Okay, so, you know, but my preferred short is this. Why do I have to be a hero? Oh yeah, 5-1 on the, they're doing it on the Nasdaq 100, or they're doing it on Tesla. They're splitting the Nasdaq. Sell rallies, Martin. No joke. I'm going to let the rest of the team cover it. Okay. So Blake, how are you? Everyone wants to know everything, and Blake's bias chart covers all the majors. So I'm going to
hey, good morning,
hey,
Coach.
buddy. Hey, buddy, how are you?
Good. Just, you know, it's a really, really, you know, quiet but grinding session. The dollar's been, you know, just kind of pulling lower in an overall range. So,
yeah,
you know,
dog days of summer, bro. Until
it is.
You know, people. I'm not sure people took vacations like they did last year in the middle of a pandemic, but you know, I've
No,
noticed that every year there's kind of like that thing that's programmed in us, like, you know, birds that you know, fly away for the winter, that everyone gets back to business after Labor Day.
I really thought that this summer was going to be different. I really did. I was, I was in the camp that, oh man, here we go. We're going to have a summer where everybody's in front of their computers, everybody's trading. It's going to be wild, but unfortunately,
well, we got
it's
a
not.
couple of weeks, and I think that Labor Day is
No,
only a few
no,
weeks away.
you can just stick a fork in it. I think we're done. I think we're done for the month.
Okay.
No, I mean,
Yeah.
I'm joking. I mean, really, we could still have some volatility. I'm just saying that I expected more volatility this summer than we got.
Yeah.
So
Yeah.
that's all I'm saying. And yeah, I mean, uh, August we can still see some volatility. The second half of this month for sure.
Yeah.
Remember, we are in an election season, so things can definitely pick up at any moment in time. So. Anyway,
What do you think of euro here, Blake? Is it? You think it's still worth a short with stops over the recent high, or is it a I don't know, no trade?
Well, I mean, this wasn't this. I first of all, I think it's a short, but B, I was looking for a little bit higher, personally, and not necessarily at these levels. So if you look at the euro dollar, I was looking for this confluence up here around 118.70, and that's not to say that we won't get there today. We could definitely get there today. So
Yeah.
I was looking, especially with stocks as strong as they are, the dollar should stay relatively weak. And so I'm actually, and I'm going to write this down on the bias chart anyway. So just to answer your question, I think that you can play this range. What I'd rather do is rather be short the euro dollar at the 118.70 level with a decent stop in place versus being short right here near the middle of the range, if that makes sense. Right. So, I'm going to write down that resistance right now. Oops, the enter button too. 118, dang it. Hold on. 118.70, I think, is resistance. It's still, but remember, we're still in a bullish trend. I don't want to, dismiss the I don't want to dismiss the importance of the bullish trend that we're in. We're still in a very bullish trend. What I've been hoping was going to happen, but with stocks up here, it's hard for it to happen. Is I've been hoping the euro dollar would pull back a little bit, but nothing's pulling back. Stocks aren't pulling back. That means the dollar's not going to rally. All the same type of arguments here. So let's take a look at where support would be. So support today, in my opinion, is going to be the lower end of this. And actually, I'm going to drop this support zone down a little bit. It'll be right here. It's going to be right around I guess that comes in right at 118. So 118 should offer support, but 117 below that, 117.10 actually. You guys have to remember all the stuff that we've been putting out all week. So 118 is going to be support today. Should be minor support today. All right, let's go over to the cable. So the cable, if you're wondering why the cable is so strong, just go look at the guppy. Go look at the pound yen, which I'm not going to go over right now. But the pound dollar is closing in on the 618 retracement that comes in at 131.15. I was sitting here this morning, we were in the chat room and looking at the 131.05, and I was like, man, I should just short it up here. But it's like, it's hard to, when things are just kind of bouncing around, it's like, do I really want to take a stand being long the dollar against the cable when the pound yen's ripping and stocks are moving higher? It's tough. It's a tough trade right now. So, but I do think that this is resistance, the 618. I think that we are making lower highs. And one of the things about the cable that you have to kind of pay close attention to, it has been underperforming. So just think about that a little bit. It's been, a relative underperformer as of late. I know it's up today, but if you look at the euro compared to like the euro, it's not performing as well, in my opinion. All right, so 131 16 is going to be resistance. So 131, let's just write 131.15. And then beyond that, obviously, it's if things get going, it's 131.85 is the key resistance. So support today is going to be dips down to it's right here. I mean, 130. I mean, that's just key, right? And is the cable. We can get down there for whatever reason. Aussie. So the Aussie, the Aussie employment was good. It was a good number. 114,000 jobs were created. I think the unemployment rate went up just a hair, but the participation rate was good. So all in all, the Aussie employment was good, but the Aussies surprisingly capped, and that is and must be noticed, right? So today, the 71.90. I mean, look at how we've just been nudging up against there, still resistance, right? So 71.90. I still think it's bullish while we're above 70.70. So you guys, 70.75. I know I've written down that number probably every day for the last 2 weeks, but I mean, it is what it is. We are above this key support, and while we're above this key support here, there's no real reason to be bearish while we're above this breakout point here. And what I'll do is I'll do this really quick. I want to make that a dash line. Too big a dash. Dot. Dash is fine. This way we kind of know where it's at. That's just the breakout point. Period. That's where it's, as long as we're above that, it's supported. All right, let's take a look at the Kiwi. Let me make sure I've got that bullish. Okay. So the Kiwi, is trading a little heavier. But we're still above that 65-cent level, which, we've been talking about all week. This is pretty good support here. I think while it's above 65 cents, you got to be careful being on the short side, because it's just, the dollar is just, generally speaking, weak. All right. But if the dollar does start to bounce, then, we'll be paying attention at that 65-cent level. And for intraday, this is an hourly chart, 66 cents is resistance. The Kiwi is underperforming the Aussie. You can obviously see it in the Aussie New Zealand. So I'm going to keep it on range. I've been switching back and forth between being bullish and being on range. But the thing is we are below the 66-cent level, which is, this breakout point here. So I still think it's bullish. It's just, you got to be a little careful. Hold on. What's that? Apple kicks off 4-part debt offering, including 40-year bond. Apple is selling a 40-year bond.
Yeah, because they don't have enough cash, do they?
Yeah. What the? Well, first of all, I'm going to tell you. I'll tell you this right now. I wouldn't buy anything in technology that's a 40-year anything. Take a look at anything in technology. I mean, the Apple may be riding high right now, and look, I use a lot of Apple products. I have an iWatch. I have, I've been using iPhones for probably since the second version. I don't know, but realistically, there will be somebody that will come along and probably dethrone Apple at some point, right? I don't know.
Always happens, man. Always happens.
Yeah. I mean, whether it's your Toshiba television or Zenith or, I'm just saying, over time, there's no way.
Good morning, guys. Just 13 years ago, I just jumped on the webinar, so I don't know if you mentioned it, but just 13 years ago, everybody believed that Nokia is going to be the king of phones forever. Just 13 years ago.
Yeah, and Motorola, and I mean, look, that's scary. Hell no. And especially when you don't have the founder. I mean, when Steve Jobs died, I think, I mean, look, Cook has done a good job as far as navigating the company, navigating it, but the ingenuity went out with the passage of Steve Jobs and the creativity, in my opinion. So, but like I said, I use Apple products, but they're just maintaining now. You're not creating anything new. But anyway, all right, that's a big debate that could go on and on and on and on for hours and hours and hours, and there's no winner there. So I'm going to go over to the Canadian. So the Canadian is just the next one down. I'm so irritated. I've been trying to play the Canadian on the long side. This one has really, really irritated the heck out of me. We are breaking through lows, and I had my stop down here, and I told everybody when I got stopped out this morning, I'm like, watch, this is where we get our 50 pip bounce, which I joke around with this a lot with our traders. I usually keep my stops pretty wide, but when I have them tight, like I kept this one relatively tight. And it's a small position. It wasn't big, but the thing is when I get stopped out, it's usually like the time to reverse. So when I say it's probably going to rally substantially, I'm half joking about that. I'm actually quite serious that it probably is going to rally. And anyway, but here's the way I'd be looking at the US dollar Canadian right now. Because if you think about it, this is right here, the breakdown point. That is where we would reverse. So if we're in this descending wedge here, above 132, you could actually say 132.50 is probably pretty good resistance today. I won't even put it on bearish. I know it's starting to break down today, but don't get too excited about that. I still think that the Canadian is acting much better than than a lot of these other, or it's actually acting, a lot worse than a lot of the other major currencies. So, but for right now, the next support for the dollar Canadian would be the 127% extension of this move. Plus, it's a long-term trend line that comes in. Oops, here's a weekly chart, right? It comes in around 131.80. So that's going to be your next level support, 131.80. Okay. Let's go over to the Swissy. Swissy is range bound, just if you guys haven't seen it. There it is. So support being 90.50, resistance being 92. Actually, it's 92 and 92.40. I think it's the same levels we've been writing down every day this week. So 90.50, 92, 92.40. We're in a bearish trend while we're below that 92.40 level, but can always set up for a double bottom. US dollar, Norwegian krona, we are at the 161% extension at 888. I think this is actually pretty good support. There's a bigger 161% extension comes at 881. So 881 and 90, by the time we get up there, it'd be 9. So 881, 9. Bearish. Yen. Dollar yen continues to hold up pretty well. If you guys haven't seen it, the euro yen looks strong. The guppy is strong. But we are struggling at this 50% retracement that we've been talking about, and that's at 107. So 107, then the next stop would be 107.20, which is 161% extension of this move down. That comes in right there. So I'll write down 107, 107.20, and then 107.70 would be next. But I have a hard time being bullish here. Support 106.50 is the breakout point. I think that's the number we wrote down yesterday too. So we're gonna, whoops. Dollar index. Let's look at the dollar index. Same crap as the euro, basically, is range bound. And let me delete this really quick because we held those range highs, which, you know, obviously that comes in at 94. 94 is key resistance, but let's look at support here. 94. It is bearish. Well, we're below 94. Sorry, guys. As you know, getting up in at 3 o'clock in the morning doesn't do me any justice. So we have 93 support right here, and then below that would be 92.50. So 93 is the 618, and that is holding. So we should take note of that. 93. Whoops. Hold on. Let me just make sure that was 92.50. It's still the same support down here. Yeah. Intraday 93. Okay. All right. Let's talk about dollar MEX. Banxico rate decision today. It's at 2 p.m. Eastern, so it's about 5.5 hours from right now. We're range bound. 2260, 2225. I don't have to, you know, talk much more about the range boundness of the dollar MEX. However, it looks poised to break soon. Now, remember, we came out of a down channel, so that's why I'm bullish. All right, I've been bullish ever since we broke out of this resistance. We've just been kind of holding and maintaining. The reason why that is because stocks are strong. If stocks ever weakened, the dollar Mexican peso would trade up towards 24 probably. All right. So that's something to keep in mind with this dollar Mexican peso. Now, the market's expecting for Banxico to cut rates from 5 to 4.5%. I think 24 out of 26 economists, or is it 22 out of 24? Anyway, majority of them are expecting a half basis cut, but a hawkish hike, or hawkish cut, excuse me. It's to be seen. It's to be seen how that would affect the peso if they are hawkishly cutting. That means they cut rates and you basically make you believe that they're not going to be cutting rates much more. That might actually be viewed as a negative for the peso, as the markets tend to celebrate. The currency celebrates when you have a central bank that is just being more accommodative. So if they're not being as accommodative, or if they cut, by half a basis point, but they basically lead us to believe that that's going to be it, the dollar MEX might actually go higher. So just think about that, as we go into today. Okay. But support is at, and I'll be obviously in the chat rooms regarding the peso, because I do have exposure. So 2260 is, in my opinion, resistance. I believe if we break 2260 for whatever reason, we should that's a double, triple, quadruple bottom. That'll just take us back up to 2290 again. All right. Last but not least,
we have numbers in about 30 seconds, by the way.
Oh crap! Thank you. Appreciate it. Well, unemployment claims, right?
Yeah, initial jobless claims expected 1.1 million. Continuous jobless claims expected just below 16 million.
Okay, there you go. There's your data flash. This comes with Forex Analytics, by the way. So if you use Forex Analytics, you get that. This is almost as fast as the Bloomberg. You'll see the Bloomberg data come out, but crap, this is Bloomberg over here. What jobless claims right here? They haven't been released. Oh, look, they hit here, and they haven't even hit Bloomberg. They hit on data flash before they hit Bloomberg. Wow, doesn't happen
Nice.
often. Yeah.
Okay, so a little bit better overall, both the initial and continuing.
Nothing magnificent, but a little bit better than expected. Yes.
Yeah. Okay. All right. Well, that's it. Talk to you later. No, I'm just kidding. I still have to do. I have to do gold and silver.
See you all tomorrow. Bye bye.
Stocks. See you later. Okay. So obviously the equity markets. I mean, the S&P is. We're how many points? What is that? 15 points from all-time highs, roughly. I mean, what do you say about that? I mean, it's just path of least resistance. You know, everything's going up. Just continue to go up. All right. So 3,400, while we're above 3,300, it's bullish. Gold, like I had mentioned to you guys the last couple of days, and I'll reiterate with gold. Gold is bouncing around between 1,900 and probably 2,000 now. So, you know, here, move that. So the 618 comes in at 1994. So that's 2000. Like I said, support's probably going to be at 1900. I think we shook the trees here. And in the case we break into new lows, this is where I'd be a buyer. I mean, I'm not trading gold, and I own physical, but I'm not trading it. But if I was going to trade it, I'd buy it on that 38% retracement on a dip to new lows. That's where I'd be a buyer. But that's, I don't know if we're going to get down there, frankly. So I still believe 1900.
Everything can happen.
1995. That's right. And I still think we're bullish because remember, we're still, holding, basically maintaining the all-time high. So there you go. Your bias chart is done. All right, guys.
Everyone get their Polaroids out.
Yeah, go ahead and take a picture of the bias chart. And last thing I need to mention, guys, if you're not part of the Forex Analytics family and you want to be part of the Forex Analytics family, please visit our webinar sponsors. Pepperstone Securities is our sponsor for anybody that's outside of the U.S. or Canada. If you want to possibly get Forex Analytics for free for a period of time, you can actually open a Pepperstone account. And then from there, once you start trading live, you'll get 2 months free when you open a live trading account, 2 additional months if you trade over five standard lots. And then if you're in the United States or Canada, please visit Forest Park FX. They are also our webinar sponsor, and they will help you find a broker that is best suited for your needs, but also gives you cashback rebates. So make sure you visit Forest Park FX. All right, so guys, I'm going to pass it over to you, and I want to thank everybody for being here with me. And Steve, Stelios, Dale, it's all yours.
Thank you, Blake.
Thanks, Blake.
Thank you very much.
Good luck to everybody.
Hello,
hey,
Coach.
Guys, you know what? We take orphans, right? Trading orphans that need a family.
Just to add here that they need to follow the steps. Once they open an account, they need to, mail us, etc., and request the extra months. We check it up, and they have a Forex Analytics subscription for 2 months. And if they trade 5 lots, those 2 months become 4. Okay, so what were you saying? We take orphans?
Oh,
really?
Orphans. If anyone out there is, feeling lonely and they trade and they're an orphan, not many of their friends do it. They don't understand what they're doing. Their friends think they're crazy. Their family's telling them get a new job. I say join our family and have that emotional support and go through the twists and turns of trading with people that are going to be supportive in our chat room. So welcoming all orphans to join today. I think there's an orphans discount on a 6 or 12-month subscription that Joe Perry will handle. Catan, you're an orphan? You're okay. All right. So Stelios will put Joe's email in there. And on Thursdays, we're doing this. So if you want a 6 or 12-month subscription and you're looking to be adopted, we'll take you in and we'll do everything we can to help make you successful and at the minimum, help you not blow yourself up. There you go. There's Joe's. Okay, go ahead, guys.
Hey,
That's my
hey
big
everybody.
pitch. Boys Town. We're all, and girls are welcome too. Boys Town was an orphanage. Andy Rooney was in that one. Made me cry. Anyway, go ahead.
You're savvy like me. Yeah.
I cried. I cried when Bambi's mom got caught in the forest
Yeah,
fire.
I know.
Oh man.
All right.
So what do you guys think?
So
what's new?
Couple of things to mention. Let's get data out of the way. We had Australian employment change came in a lot better than expected at plus 110K or so. Interestingly, the job losses from what was it? April and May, or May and June. Over half of them have been taken back in Australia, which is, it's quite encouraging. And then we had jobless claims here in the US, nearly another million. That's a little bit of a different story, but otherwise it was very light in terms of data. We did have some more stuff coming out of the US. First of all, the Democrats and the Republicans are still not agreeing on another stimulus package. Mnuchin says that Pelosi doesn't want to compromise. Pelosi says that Mnuchin doesn't want to compromise. It's a story, but anyway, the bottom line is that they're not agreeing yet. On the other hand, Larry Kudlow said, "I'm not too worried. The economy is doing great." So
absolutely. So if it's doing great, if the economy is doing great, then there should be no discussion about stimulus, right?
Yeah, or raising rates from zero.
Yeah.
So
I mean, we can just, get rates back to like more normal levels, cut all stimulus, because after all, the economy is doing great.
Yeah. Yes, that's a good point.
Booyah.
So we also had Trump tweeting quite a lot this morning.
Kamala?
He said no, actually he's more talking himself up for the election. So he's saying, look, if I get reelected, the dollar is going to be even stronger. This obviously is a direct contradiction to what he's always been saying for the last years, that the dollar is too strong, it's hurting growth and manufacturing. But who cares about that? It's what he's saying today. And he also said he's going to cut capital gains tax to 15% in his second term. So, promises from politicians, nothing new. Everybody does it. And this is what Trump has been saying this morning. Now, on to markets. The stock markets, S&P is very close to new all-time highs. I still think we're going to get them. The market needs to get them. Shorts need to get basically all out of it. And then everybody realizes markets can only go up forever. They get long, and then we can have a proper leg lower, but, one step at a time. Precious metals, I've been talking about these for a while now. I'm still running a quarter of position long silver just because I never want to be flat. But I do think there is going to be the correction that we saw a couple of days ago is going to have more legs. I think it's a bit premature to be buying the dip. That's my humble opinion. I think gold can easily get to 1800, and silver can easily get to 21. Those are the levels I'll be personally looking to start to load up again. And another thing I want to talk about is bonds. If you see, I've been saying this for a while. I'm short bonds. I have been for a while. It costs pretty much nothing to hold that position. I'm down like 0.5% or something like that. Treasuries and bonds are going lower a little bit. And today's story about Apple just tells you everything you need to know, in my opinion, about bonds of any type. When you have a company like Apple who's sitting on what is it, 400 billion in cash, and they're issuing 40-year bonds, that tells you that they think that rates, especially long-term rates, shouldn't be there. And frankly, I agree, they shouldn't be there. So when they're taking advantage, when a company like Apple takes advantage of that, it just shows you, in my opinion, that something is where it shouldn't be. So
central banks have completely destroyed the markets, because in essence they've transformed more or less all assets to risk-free assets, which makes zero sense.
Yeah. And for people, I don't want to be misunderstood about equities. I have a bearish bias. I'm not short and I'm not long either. I've missed this run. I went long some in late March, not enough as always. I've had a bearish bias, but I'm not short yet. I've missed this run, and I'm happy I've missed it. It's okay. I caught silver, I caught Norway, I caught other stuff, but I'm not short, not yet. I will see how it goes. And that's pretty much it. We don't have anything else data-wise today.
You mentioned bonds, by the way, Stelio, before.
Yes.
I wrote that in the weekend analysis. Bonds were testing a very nice confluence of multiple resistances here. The longer-term channel, this ascending channel, the 88.6% fib of this move lower, and the rebound higher was clearly, both showing momentum divergences and waning, and we do indeed see now a move lower. So I do think that this was a nice risk reward opportunity, being from close to 178, being short the bonds, and I wouldn't be surprised if we actually see this move unfold lower, significantly lower, and we can still be in a long-term bullish consolidation, but we have a lot of room to move to the downside even within that context.
Yep. Yeah, I agree.
And here's the 10-year, by the way. So 10-year, currently trying to break through this ascending trend line support. If it does, it's going to open up more downside, but with especially the treasury market being now a more or less one buyer's market, I would be very, very, very skeptical about how much it can move to the downside for the time being.
Yep.
That's why it will.
Yeah, it might,
because
it's
you're not the
easy.
only one that has that feeling. As everyone feels like they're fighting the Fed, looking for higher yields here. Which
no,
they probably are.
I do believe that the Fed is going to eventually lose totally control. Do I think we're there yet? I don't think we're there yet. That's that's the only difference.
Okay.
I'll if we're done with the rest, Stelio, I think I'll start from where I usually start, which is having a first look of what's happening with the DXY, and the DXY tells us more or less what it has been telling us for several days now. It's telling us that the tumble lower has. No, actually, I think it's telling us a lot of things, Dale. Okay. It's telling us that the downside momentum has clearly stalled, but on the other hand, it's telling us that bulls keep failing in actually, managing to push the index higher, and that's especially given the fact that we got rejected once again yesterday from 94. The more days, the more hours, and the more days we spend within this little rectangle, the more the chances increase that we're just not going to rebound higher, and we're just going to resume lower, breaking through like 92.40, which is roughly where support is, 92.40, 92.50, and get at least one more leg lower before we can even consider a strong rebound to the upside. Perhaps the likeliest scenario would be something like that. I'm not saying that the chances of breaking through 94 are zero. No, they're not. And as long as we remain in this rectangle, you should be open to the possibility. But I'm saying that for every day that passes and we don't, I think that the chances of just breaching through support and seeing at least one more leg to the downside significantly increase. So I think that we might get higher dollar prices only after we see a lower low for the time being. And after examining the DXY, it's not surprising that the Euro USD looks as a mirror image, consolidating probably before seeing another leg to the upside. The cable, more or less the same deal here. Here it is. Perhaps that's not the formation we should be focusing on, but more or less something like this. Right. So I think it's quite dangerous trying to fade dollar weakness just yet. Not from what I'm seeing here. I can tell you that much. Also considering the fact that, as Blake mentioned, there is no doubt stocks remain very well bid. You can have a look at the Nasdaq. We can have a look at the S&P. You can have a look at the Dow Jones. You can have a look at the IWM. In varying degrees, they're doing pretty well, and there is no technical damage done, or not even close to getting any technical damage done. And we know that as long as risk assets remain well bid, it's an extra reason why you wouldn't necessarily expect to see a stronger dollar. I do think that we're going to see a more decent dollar rebound that will coincide with some risk of move, because of course we're going to see risk of moves on the way. I mean, even if we assume that the infinite amounts of stimulus and inflation created by the Fed will keep stocks elevated for a long period of time, there will still be on the way sharp corrective moves lower, because usually these type of binary markets, they either grind slowly higher or produce sharp short-lived corrections lower, which is more or less what I expect for gold to happen as well. I mean, I believe that this corrective move lower that we're seeing in gold and silver, it is sharp. I think it might actually unfold even further to the downside, but I do think that it's going to be short-lived. I think it's going to more or less mimic the characteristics of the move we had back here in March, which was a rather strong move lower. I mean, we went from like above 1700 to 1450 within a matter of a few days, and then the market just forgot all about it and kept grinding higher and then even accelerated higher. I think this move lower is going to probably be bigger than this one. Might unfold like this more or less, right? But I do think that soon enough market participants are going to realize that real rates are not going to be climbing higher. And once they do realize that, gold is going to be on its way to higher highs once again. Keep in mind that gold, especially gold, tends to have multi-year bull markets. So if we assume that the beginning of this bull market was in the end of 2015, which somebody can make an argument that the beginning of this bull market was actually during the summer of 2018, so that just like 2 years ago, right, when we had that low over there. But even if we assume that the beginning of it was in 2015, just look at the duration of the previous bull markets for gold, and you'll realize that they were multi-year. I mean, they lasted a lot more, and they produced much bigger gains. And that I think in an environment that was never as supportive as it is now. I do think, of course, that in the past, during these bull markets, we had very supportive and fundamental environment for gold, but I think it was never that much as it is now, because not only we're getting a lot of stimulus at the moment, not only we're getting a higher chance than ever in the past to see stagflationary environment. Not only we don't even have any target in sight of when this insanity might come to an end. I mean, the Federal Reserve might have persuaded a lot of investors back in 2008 that what they were doing was a short-term gig that would be reversed within a period of a few years. That's what Bernanke claimed multiple times, one of them in front of Congress. And for a period of time, people might have actually believed that. But I don't think there is anybody foolish enough to really believe that there is an exit strategy from the Fed. If there was no exit strategy from a $4 trillion balance sheet, like roughly 12 years ago, and with debt being much lower and deficits being much lower, there is definitely no exit strategy anymore, right? There wasn't even then, but in retrospect now everybody realizes that. But even if we assume that back then there might have been some kind of an exit strategy, there isn't one now. So I think that people shouldn't be trapped in all the nonsense. I see like a lot of people trying to claim that this has been the high and that's it. Now people that were buying at 2000 are going to be losing their money. Yeah, buying at 2000 made no sense in the short term, and we said that multiple times. The move was overdone in the short term. There's no question about it. But do I believe that people that actually were short term foolish enough to buy at 2000 before waiting for a pullback are actually, if they hold in their holdings, that they're going to actually end up losing money? No, I don't think they're going to end up losing money. I think in the long term, they're actually going to make a lot of money as well. It's not that I'm advocating that you should be buying or selling with a bad risk reward, but still. Same deal more or less with silver. I mean, silver had an explosive move higher. From a technical perspective, as long as we trade above $19, there is absolutely no reason why I would want to even consider the possibility of being short or whatever. I think there is a very good chance that we're going to see another leg lower, at least one more leg lower. I think like 2660 was, this 2630, 2650, that was an interesting area of resistance. Even if silver rebounds higher, there is a chance we're going to see another leg lower towards like 22, 21, at an extreme case scenario, even back down to 19. But I think that's going to be, if you get that lucky, that's going to be a magnificent buying opportunity. We have a question about, so DXY below 88 was not out of the world and has been in the past. Don't think it's the end of world as much as Steve says. It will be just a rotation, and currency is definitely to stay as long as people need it, and unless there is some huge disaster for mankind. So let me understand. You believe that the dollar is not easy to go below 88 when in fact it was trading at 70? So it was trading at 70 with the US economy being at a much better position than it currently is, but you think that 88 is a buying opportunity? Okay, good luck. You be my guest and buy at 88. That's what makes a market at the end of the day, right? I'm not saying that dollar is going to move in a straight line because almost nothing does. But do I believe that dollar is eventually going to bridge through 88 and move a lot lower? Absolutely. Platinum, natural gas, TLT, Aussie yen. Yeah, Aussie yen. This is something we haven't recently had a look at, but it's interesting. That's why I'm going to have a look at it at the moment. We spoke about it at some point, if I remember, last week, and I actually showed this triangle, this ascending triangle. So I think it's an interesting formation here for multiple reasons. First of all, it's a flat top triangle, which, it's very appealing in the sense you have a very well-defined resistance. You also have now a very well-defined support, and the range in between is very, very tight. So that means that sooner rather than later, out of necessity, there's going to be a breakout. Now, it looks to me like it wants to break to the upside. We also have this interesting trend line in the RSI index as well. So we are concurrently now testing both this horizontal trend line resistance on the price chart, but we're also testing this descending trend line resistance in the RSI. I think a breakout from this 76.80, you want to say, it's 77 to round it up. It's not going to make, in the grand scheme of things, it's not going to make much of a difference. I think it's going to be a nice technical breakout with the next upside area of interest being at 81. So more or less, that would point, in my opinion, to likely 300 people move to the upside in the case of the Aussie yen. So I do think it's an interesting chart. And it is one that I'm actually paying close attention to, because I think we're going to have developments very, very soon. Platinum, natural gas. Listen, nothing really has changed since yesterday in platinum. I'm going to be very brief. Platinum above 875, still bullish. Above this confluence of supports at 875, it's still bullish, remains in this ascending channel. Natural gas looks like to me like it's forming some type of a bull flag above 205, still remains bullish, and I think it looks good for another extension higher towards 2.5, 2.6, something like that. Eyeing the 10-year like a hawk. Yeah, 10-year obviously, correlates with a lot of stuff in the market, and the market always pays attention to what the bonds are doing. Another question about Aussie yen, we did cover that now. Nifty, natural gas we did cover. Having to do with indices, nothing has really changed since yesterday. Just to reiterate here very briefly, 3,400, 33.97 to be exact, is the first area of resistance. Above that, we also have at 34.16, the 161.8% extension of this move. So, a lot of resistances between 3,400 and 34.15 in the S&P. Having to do with the Nasdaq, still paying attention to this ascending channel. 11,540 is a nice fib extension. Another one can be found at 11,700. So between 11,500 and 700, a nice area of resistances. I would definitely start being very careful there. Or alternatively, if we break through this channel trend line support, then you should start getting, very cautious. I've already said that the VIX chart is sending out signals that you should be very, very careful, because it keeps diverging and diverging, both in comparison to the S&P. That's in any case the volatility of the S&P, right? And it's also diverging, having to do with RSI, so on and so forth. So I think this is not the place anymore that you should be long. I mean, if you're long, holding your position and monitoring support levels makes sense, but buying the S&P or the Nasdaq up here to initiate fresh position is just crazy, if you ask me, as it was crazy if you attempted to do that with gold at 2050 without having a prior position. So it's the same type of concept. I mean, all of the US indices definitely are in desperate need of some type of a pullback to work out the overbought conditions at the very least. S&P's valuations are getting eerily close to the 2000 highs, which means that if this continues for a little bit longer, the S&P will actually surpass the 2000 valuations, and that tells you all you need to know. Now, that doesn't mean that the bubble can't grow bigger, right? This is what bubbles do. But I'm just saying that, you should at least wait for pullbacks to make somewhat more of a sense getting exposure to these markets. Unless, you're the type of investor that you just want to close your eyes, jump on something and, cross your fingers and hope for the best. But in my opinion, this is not a long-term strategy that can result in anything else than you being broke. So, you want to take my advice, fine. You don't. You own your decisions. Yeah, as Nikita says, gambling is not the right thing to do in any case. Now, something that's not very popular, unfortunately, I forgot to mention it earlier. I was monitoring both the Aussie CAD and the Kiwi CAD. I forgot to mention the Kiwi CAD last week, and it unfortunately has already broken down quite significantly. The Aussie CAD seems to be lagging. I find these ascending wedges quite interesting as formations. So I do think if you want to look at something that doesn't give you any dollar exposure and looks interesting from a technical perspective, but perhaps you should consider short positions in the Aussie CAD and the Kiwi CAD. And one more thing I wanted to show today, and anyhow, I think I've run out of time, is the CAD yen. We had mentioned the CAD yen last week, and specifically, I remember saying that's in an interesting rectangle, which it has to eventually break either higher or lower. And it has actually broken, like earlier this week, to the upside. And this is quite a nice bullish development. And I do think it should be producing, even more gains. I would be looking towards 82 to begin with, but even 83, perhaps attacking once again this longer term ascending channel trend line resistance.
Nice look.
Thank you, Dale. Who do we have today?
Dana Lyons.
Okay.
And Dana was great last time, even though he was bullish. He came up with a thesis that we were still in a secular bear market, and that washout we had on the COVID crash.
Wait, secular bear market in the US indices we're talking about?
Yeah.
Okay.
Yeah, stick around for this one. Okay, so Dana, welcome back to Face. I'm going to get you set up as a panelist. Where are you?
Dana Lyons, you said?
Yeah.
Okay. Yeah, I'm promoting. Don't worry.
Okay.
There we go.
Hi, Dana.
Wait. Give it some time. I'm unmuting.
What a producer. There we go. Welcome back, Dana.
Thanks, Dale. Nice to be back.
Okay, so do you remember how to use Zoom to share your screen?
Well, how about that green button that says share screen?
That's the one.
I'm telling you, you're like Sherlock Holmes.
All right. Should I just click that and just leave it on that?
Yeah. Click that and then choose the screen you want.
Click that and then you have to choose which screen or window you want to share, and then you're good to go.
I got you. Excellent.
So I was really looking forward to you coming back. I was just telling Steve that last time you were there, and it was before the highs that we had in February. I'm not exactly sure, but you still brought up the secular case, secular bear case, and that's what it did. Kind of just washed out under those lows for to go the bottom of the megaphone.
Yeah,
and that was a great call. That no one's saying that we're in a secular bear. So even though they're long and participating in the market, I'm not saying you're a permanent bear. I know your positioning is with the trend. Yeah. So I guess the question is now, Dana, that we had that break and here we are at new highs. Is this just like a continuation of a broadening formation? Why don't you tell us what you're seeing?
Yeah, sure. Well, it depends what index you're talking about. So, and it depends not just on a price series like the S&P 500, but we're really talking about the economy, the market, the broad stock market as a whole. So our thesis was still that in 2000 we topped out, and the way that secular cycles work is you have big buildup over secular bull market over a couple decades, and you build up these excesses in the market and the economy, and they have to be worked out and corrected before a sustainable bull market can commence.
Fed
And
won't let that happen, Dana, will they?
Pardon? Well, that was going to be my point. You know, in 2009, it works just like physics. You know, you go to an extreme to one side, then you have to go to the extreme the other side. It's like Isaac's laws of physics. And we basically in 2009 it was bad, but we really got down to the mean in a lot of economic and market metrics, valuation, the percentage of household assets and stocks, even price trend itself. So we never corrected to, you know, the bearish to the downside extreme like we needed to, thanks in part, I think, to the Fed and central bank intervention, like you mentioned. So I think that had a lot to do with it. So now we have a lot of those excesses that are still in the system from 2000, in addition to everything that's been put in since then. So I don't like to opine too much on central bank stuff, but just looking at why the cycle hasn't played out like it always has, I think that has a lot to do with it. Now, if you look at, for example, you know, we have the S&P 500 back testing all-time highs. But if you look at, for example, here's the value line geometric composite on my screen. You see the top in actually 1998. We've gone pretty much sideways since then after that long bull market preceding it. So the median, the value line tracks the median stock performance in the market. So basically we've gone nowhere. Now, most people are in something like the large cap, the S&P, some of the Nasdaq type, whatever's popular in the day. So most people have done a little bit better than this, sure. But if you look at the broad market of stocks, we really, it's still conceivable to make that secular bear market thesis. So that doesn't mean that, as you alluded to, that doesn't mean that we're going to invest our clients' money based on that. We're more intermediate term duration. So for 2 to 6 months, our normal signal lasts. So we're gonna have to be on the right side of the market during that intermediate term duration, or else all our clients are going to fire us.
Did the magnitude of this bounce after that crash surprise you?
It did. I'll tell you, not much surprises me in the market anymore, but the magnitude, the way we bounced back. I mean, face it, we had the biggest, swiftest crash in the history of the U.S. markets. Right. To expect the swiftest rebound in the history of the U.S. markets was, if you're going to tell me that you expected that, I'm not sure I would believe you. So we were surprised at that. At the same time,
I was trying to sell failing rallies at different fib levels.
Absolutely.
So
the big one, if you look at the value line here, the big level was in early June. So this is still, if you look at the broad market, so in early June we pretty much failed right at that 61 retracement from the 2018 top. Also, you had a couple the green lines, the 200 moving day. So you had a bunch of technical reasons why we should fail there, even though the S&P and some of the large cap averages had moved well above those corresponding levels. So we did top out this move in early June, kept the bear market, not the secular one, but the near-term bear market thesis on the table, that this move since March was merely a bear market rally. Now, recently, we've seen some of these lagging areas of the market, small caps, financials, energy, some of the European and international markets move back above some key resistance levels, opening up further upside. So that does open up a little bit further upside. And we have some of the leaders going to all-time highs. So it makes you reconsider the fact that, okay, we had a bear market in March. This is just a bear market rally. So maybe it's something more than that. And you have to consider that it's going to extend even a little bit farther.
Okay, here's a key question for you,
sir.
Dana.
Yeah.
I'm transferring my $1 million trading account to your RIA. all cash. All right, it's all cash.
Yes, sir.
What do we do here?
Our philosophy is we're going to be investing with the trend. The trend right now is up. Our risk model, which is comprised of a lot of breadth measures, is strong enough. It's stagnant a little bit now, but it is still in a buy position. So we are still.
So you put some of that money to work. All of it.
We're still bullish. The problem is right now is it's not. Well. Like I heard, I was listening to your prior commentator, and he was mentioning if you're long now, we would stay long. If you got a lot of cash on hand, we wouldn't necessarily be deploying all that cash right here. So that's basically in the position we're in. So we're long. Okay. We're long a lot of the longer term relative strength areas, technology, healthcare. Stuff like that, stuff that's been working for a long time.
Were you there for the miners?
Gold miners, exactly. Gold miners as well. So those relative strength leaders, that's our philosophy. We want to be in the stronger areas of the market over the longer term. So those areas we'd be looking to redeploy that money and buy the dips. The laggards that have come on of late. Small caps, financials, energy, those are more of a that's more of a flash in the pan type of move to us as of now, until they show something on a longer term basis. We're going to avoid those areas. We're going to sell those rallies. We're going to even try to short some of those areas into resistance. So we've seen
Dana, isn't that also a sign of a rally being long in the tooth when they rotate into the trash non-performing stocks?
Sure, that can be. We have a number of other red flags that we've noticed as well. Some breadth has held up okay. We've seen some one-off days where we've seen big rallies on terrible breadth, and that has often happened in near peaks in the market, although not always. So that's more of like I said, one-off little red flags. We also see, like your prior commentator mentioned, we see volatility holding up relative to the moves we've seen in prices.
So we never filled that gap at 18.
Yeah, that's a concern. But I would say it's not according to our models, it's not enough of a concern to get too defensive yet here. So that's we're kind of. I wish I could say we're at a bottom or we're at a top, and now's the time to make a lot of moves. But basically, we're in kind of a holding pattern. We're still long. We're just not going to be that as aggressive in putting money to work right now. Here's the VIX. Right. Yeah, we didn't fill that gap. Actually held the 88 retracement and some other support areas around the 1920 level. So perhaps even more interesting, the volatility index in the Nasdaq 100, which is held up well above the prior lows, actually well above even the June and July.
They're making higher lows.
Yeah, so that's one of those red flags. It doesn't go into our models necessarily. It's not an actionable indicator for us, but
up until the last couple of days, growth has been, they rotated out of it for a while, and Nasdaq hasn't made a new high for almost a week or two.
Yeah,
which is like a lifetime when S&Ps do it every other day. I wanted to bring up something that I think just began this week. 10 years, the 10-year yield chart was like a patient in a coma, their EKG, for a long time. And to me, it looks like we're coming out of here. I'm going to have a 2-week reversal signal in the 10-year. And I can make a case for 120 in the 10-year. I know a lot of, and the mantra that is so universal, and we were even talking about notes and stuff here, is first of all, you don't want to fight the Fed, but everyone is saying lower for longer.
Right.
Powell's saying, I'm not even thinking about raising rates. Market, he doesn't have to do it. What's your view on yields here? And would a move to 120 in the 10-year upset which apple carts?
Well, first of all, taking a step back, if you leave the long term cycle of interest rates, we were due to bottom, the 60-year cycle roughly. We were due to bottom out in rates about 10 years ago. So you talk about another cycle that has been kind of upset by maybe some of the central bank action that's taking place here and around the world. So back in really and when you talk about lower for longer, I think that's a key psychological factor or condition for putting in a long-term bottom in rates, because all you heard from around in the 2000s, from 2000 to up towards the financial crisis, all you heard about was, okay, rates have to go up. There's nowhere to go but up. And once we got to that lower for longer, okay, we're going to be in this low rate environment forever, negative rate environment. Then you put in the psychological condition where we can put in a long-term low and then start rising, which we think we will. So we think rates go up for, decades to come. When that starts, I don't know. We thought it would have started in 2016 at that low. Didn't happen, obviously. We rose for a couple of years, but now we're back making historic lows. But if you zoom out,
we didn't make historic lows. We got down to 50, and the spike on COVID, I think, was 34. And now it looks like we're starting to head up. And I'm not talking about this wave going to 4% on the 10-year, but why not back to 120, which was a pretty important support level before the acceleration? And do you think the market's prepared for that? Would be like up 125% from the recent reading of 50. Would it matter?
It absolutely would matter. I don't think anyone's prepared for that. What my historic move was that move in March, I'm saying. And if you're looking for, this is kind of anecdotal, but if you're looking for an ending type of a move, this blow off that we had in March, that would certainly be significant enough to end a long-term 40 year run in interest rates. But you talk about the 120 level, I'm looking at the same thing. Held support at 50 basis points, testing that 50-day now, trying to get above. If we do decisively break above that 50-day here, around 65 basis points, I'm looking up towards about 108 or so on the 10-year, and up about, if we break that, maybe I'm looking at 150. So I could see that happening quickly. Obviously, I don't know anyone.
What would be behind it? Because everyone will go, why did the 10-year go from half to over 1? The Fed's not doing it. Could it still be with everything the Fed has done? Before we had the crash, we had those issues in the repo market last fall. Could it still be that there's liquidity issues in certain money markets? I can't think of any other reason for rates to make this move. I'm wondering how. I'm not a reporter, but I'm trying to guess how they're going to explain it.
I thank God I'm not a reporter either. So you got to come up with reasons.
Well, they come to us. We'll have an explanation then.
Right. Well, the boring answer is I don't care what the reason is. Because we're going to follow
the market data. And
that's
wisdom.
We're going to follow prices. So I don't know what the reason would be. This is still a free market, right? So this is not Fed funds. We don't get set by the Fed funds. So this market's going to move based on market forces. And for whatever reason, if we go up there, that's where the market has to go. So it's not, a couple central bankers setting rates on the 10-year. Obviously, they have a huge influence over that, but they can't necessarily control that. So with the market forces, there are a couple of things we've talked about it before. A couple of things that are bigger and more powerful and I guess stronger than any central banker, any policymaker can. They don't have the ability to permanently control things like the economy, the stock market, the 10-year, the bond market forever. You know, they can distort it temporarily. They can't permanently control markets like that. They're too many players, too much money, too strong a force for one, you know, individual or one central bank to necessarily distort forever. So that's my
Someone
view.
just said printing 7 trillion in a matter of months gives you a lot of control.
Sure, it does. And we've seen, we've seen
the result of it.
I mentioned the interest rates were due to bottom. The window was about 10 years ago. So yes, you can distort it for a while, not permanently, not based on hundreds and hundreds of years of history.
Okay. So if we get this move that you think is viable, could happen, what's going to suffer? Utilities, REITs, interest sensitive sectors?
Sure. Dividend stocks, obviously, things that have those types of areas that have been lagging for some time. So that would, obviously, those areas we'd be avoiding. So we're already avoiding those areas, but the utilities had been. It was interesting. The utilities were one of those leaders for a long time, like the growth areas of the market that were leading. You had weird things like utilities doing well, and all of a sudden, since about April or early May, they have not been doing well. So why is that? I don't know. They haven't. So maybe that's a harbinger of some kind of an interest rate move here.
So maybe the thing to really avoid would be weak credits. If they're weak credits now I'm talking about junk, which used to be, you know, AAA, that rise in rates of a point might cause some duress in the bond markets. What do you think?
Yeah, that's true. And we've seen, if you've been looking at junk bonds of late, we've seen we've seen them struggling. Some of the, at least the junk bond ETFs, they've not kept up with the recent bounce in some of the junkier equity issues and equity spaces that we've seen of late. We've not seen high yield keep up with that. So that, to your point, that might be a sign of exactly that in the works here.
How do you label what we're going to be facing with, you know, all of this artificial actions that have taken place? I think, you know, really to keep everything going to year end, which includes the election, right? Next year, and a lot of it depends upon, you know, do we get a second wave? You know, do people stay home, reinforce their lack of consumer spending, especially the people with money over 55, 60 that are higher risk? Do you think that what we're facing is a credit crisis coming or a solvency crisis? And isn't there a difference between the two?
Yeah, I think I think it's going to be just a straight up demand issue. You know, it's going to be. I have to think it's going to be extremely deflationary. What's going on in terms of shutting down the economies, the lack of, obviously a solvency issue for many small businesses, which are just going to vaporize. So whatever it is, you know. Again, we don't care what's happening. All our clients care about is what's happening in the markets itself. So we're gonna. I've told a lot of people. We continue to say that we ignore all the fundamental data, the economic data when we're managing markets. If to the extent that the economic data is relevant and pertinent to the moves in the markets. It's going to show up in the data from the market. So we look at only quantitative data from the markets itself. And if it's relevant, it's going to feed into it. So the markets are you look at the stock market, it's the best discounting mechanism in the history of the world, right?
Yeah, people are voting with their wallet.
Exactly. And humans can't process that faster than like billions of inputs faster than the stock market. So take your cues from the markets. Ignore the noise unless you're, the greatest even the greatest forecasters of the market, of the economy and fundamentals. You can get that right and still get the market reactions wrong. So we'll stick with the market.
A call
data.
and a trade are two different things. So
Sure.
How about the dollar, Dana? Dollar has given up, euro from 108 to 118. You have a view on the dollar here? Is this a severe breakdown on your technical work?
It's a breakdown in the near term on the dollar. So long term, up in the air. We don't have really a long term view. We're not taking a stance on that. In the short term, I would say the benefit of the doubt is to the downside in the dollar index with next level around 91. So we're trading around 93, right? Anything up towards 96, we'd be selling it. 96 and a half would be selling it, maybe even take a shot up there on the short side. So right now, benefit of the doubt is to the downside in the dollar.
Okay. And I know you have friends and relatives that aren't your clients, right?
Mm-hmm.
Okay. So I get asked this all the time. Dale, with what's happening in the economy and what could happen in the economy, I just don't understand. How could the market be making new highs? What do you tell them?
Well, again,
you get asked that question, don't you?
Yeah, like I just said, that's why we ignore the economic. And who in the right mind would be expecting all-time highs right now, coming off of at GDP dropping by a third, and 10% of the labor force got laid off in 1 month. I mean, who in their right mind would be would have any money at all in the market right now? So
how do you explain it to people?
I say don't even try to reconcile the two. Divorce yourself from the fact that the market has to go with the economy, or I say, find a good objective risk conscious money manager and let them manage the money for you, because they'll know they'll know the inputs to look for. They'll know what to ignore, and they don't get hung up on, trying to reconcile the two. So
how are you doing this year, Dana? A little bit more than halfway through the year, ended quarters. How did you weather that decline, etc.?
We weathered it pretty well. So I mean, that's our calling card. We're gonna aggressively manage risk when we detect it. So we lost a little bit in the first quarter, the small single digits. So we aggressively went defensive there in the early March, right? Right in the beginning, towards the beginning of that swoon. So we had some red flags going into that top. We were about our risk model was a week late in getting a sell signal. So almost a perfect sell signal, but that last week of February was really bad, if you remember. So we got clipped a little bit, small single digit losses. Since then, we've made basically triple back what we lost there. So I think our clients are happy. We are always going to lag a little bit in the explosive moves off the bottom like we saw in March. So certainly we've lagged the market. We're not up 50% from the March lows, but you keep your losses small, you keep your drawdown small. You don't have to recover as quickly. You don't have to make as much back on the rebound just to get back to even and then start growing your money again. So that's why we always preach the most important thing is keeping those losses, keeping those drawdowns small, relatively small.
So Dana, if someone wanted you to manage a part of their portfolio, how would they reach you and get a hold of you and discuss it with you?
Well, you can reach us. I've got several. We got a website, but we got several blogs, several services that we can that we do provide. So
you want to show them?
Sure. Let me
figure out a new share. Yeah.
What's that? New share.
You might have to do a new share.
Perfect. All right. Yeah. The best way is let me still figure this out, buddy. How do I get on? Okay, here we go. Best way to get a hold of us, you can check out our website is Lyons Share. The Lyons Share, it's at lionsharepro.com. You can find contact information there. This is one service. We have our management service. This Lyons Share is more or less a do-it-yourself service where we provide basically on a daily basis what we're looking at, what we're looking to buy and sell, and subscribers pull the trigger themselves. But it's kind of a open lens into how we're managing money and the kind of things we're looking at. But if you want to, as far as our management service, it's jlfmi.com. And you can email me at info@jlfmi.com or dlyons@jlfmi.com, and you can find us that way. And it's if you're looking for a way to manage risk and add a significant risk overlay to your investment portfolio, that's really our calling card. So, like I said, we're not going to try to squeeze every single penny out of every up move in the market. We're going to manage risk, keep our drawdowns low, and
the difference between pros and amateurs are pros know how to lose, so they have money left to be right with.
Exactly, so, that's the most important factor, knowing when to pull the trigger on the sell side. Absolutely.
Best idea going into the election, Dana.
Into the election, wow. Right now, like I said, it's boring, but we're following the same stuff that has been working. So we're not going to the flash in the pan recent move in the small caps and financials and whatnot. We'll stick to the longer term trends, technology and healthcare, and go with that. One I would say one long shot would be Taiwan. We like Taiwan in the long term. Why? Because of the chart. We have if I can do a quick screen share if I have time for that.
Yeah, go ahead.
Okay. So we've had, you talk about a long-term bear market. We had Taiwan, which topped out in 1990. So whatever's going on, I know
when the Japanese did.
Yeah, I don't know what's going on in a lot of things going on politically in China and Taiwan, Hong Kong. But you had that top in 1990 in Taiwan, the Taiwan Major Index. Then you had a series of highs for the next 25 years. Broke out of there a couple of years ago. We've been consolidating. Just broke to a new high, all-time high here at the right of the chart above the 1990 high. I mean, you talk about, they say the longer the base, the bigger the space, the upside. This is massive upside potential if this breakout is for real. So if you want a wild card in your portfolio, you're looking at emerging markets, this would be the one that we would pick.
I'll call it your speculative shot. Okay.
Sure. Well, we're long this already. EWT would be the ticker symbol, which tracks it pretty well. It's actually at new all-time highs as well. So EWT, small speculative position.
Well, I hope you and your family stay in touch. Any view on COVID?
now we're just praying that everyone stays well and that this thing runs its course quicker, quicker, sooner than later. So don't have a view on it, but praying for everyone out there to stay safe and socially distance, and hopefully this thing runs its course soon.
Thank you so much for coming here and sharing your views with us today, Dana. I always enjoy it, and I know I could ask you anything, and you'll come right back to price.
Yeah, I appreciate it, Dale. Always right. Enjoyable talking to you, and yeah, price is truth, and stick with that. Ignore the noise, right?
All right, my trading warrior brother, everyone, Dana Lyons, you know where to find him. I would trust him with, if I had a lot of money, I'd give you a piece, Dana.
Thanks,
so anyway, so that's going to be a wrap. We'll see everyone for TGIF tomorrow. And again, my trading warrior brother, appreciate your views. And, I could kind of tell that you're getting a little strongly neutral here after this advance. Let me know when you guys get a sell signal, and let's get together maybe after the election and see what's happening price-wise then.
Sounds great. Always a pleasure, Dale. Thank you.
All right, Dana. All right, everyone. Remember, don't just count your pips, count your blessings. We'll see everyone tomorrow. You're welcome. Adios.